Hey, welcome to to Investing Part 1. What we're going to do here is go over some fundamental concepts of investing. It's an introduction to a multiple part series. I'm going to go over investment analysis and valuation, a better understanding of stocks, bonds, real estate, as well as mutual funds. With that being said, I want to get started. I'm going to be a lot more upbeat in the next couple of videos. I went back and I listened to a couple from the old series, and it's kind of monotone, so I'm going to be a little bit more exciting here. Let's get started. What are stocks? Stocks are certificates issued by firms representing partial ownership in the company. Stocks are traded on two different markets, a primary market and a secondary market. A primary market is where newly issued securities are traded. That initial offering of that particular stock is called an IPO, or an initial public offering. The most recent phenomena on IPOs was Facebook last year. Everyone heard about Facebook going public. They traded on an IPO. It's supposed to be fantastic. It turns out that Facebook's stocks dropped shortly after. I'm not going to go into detail on Facebook. I was just using that as an example for what an initial public offering is. Secondary market is a market where older or existing stocks are traded. So stocks like Microsoft or JP Morgan, Morgan Stanley, Bank of America, all of these people are established existing companies, so their stocks are being traded on a secondary market. They're public companies as well. I should put that out there. There are multiple types of investors. There are institutional investors who are employees of financial institutions, and they're responsible for managing money on the behalf of their clients. A portfolio manager are employees of financial institutions that are actually making financial or investment decisions for these financial firms. And a sole investor or an individual investor is a person who solely is investing for themselves, whether they're day traders investing at home or just the regular everyday guy working, who's also investing. An interesting note, to be considered a full-time investor, you need to be making about $250,000 a year with about $1 million in assets. Returns on stocks. There are two main ways of returning or making a return on stocks. There are growth stocks and dividend stocks. A growth stock is a stock that has the potential for substantial growth. If the price per share increases from the time you bought it until the time you sell it, the difference in price between that time that you bought it and the time that you sell it would be the revenue or the growth that you've received on that stock. So say, for instance, you bought a stock for $10 per share and you end up selling it for $20 per share. You've received $10 per share in growth. A dividend stock is a stock that provides investors with periodic income. So let's say, for instance, you invest $2 or $3 million in a company, and instead of getting a return from the growth in that particular stock, the company issues $40,000 or $50,000 a year in income, just as an example. There's two types of stocks, a common stock and a preferred stock. Both stocks are certificates issued by a firm that represents partial ownership. The difference between a common stock and a preferred stock is when you own a preferred stock, it allows you as a shareholder to have priority in receiving that income or the dividends from that particular firm. If you want to understand the value of a stock, the equation is the market value of a firm divided by the number of outstanding shares. An example here is a firm is worth $10 million and they have $1 million in outstanding shares. So the price per share would be $10 per share. If you want to know the market value of a firm, you simply switch that equation around and you multiply the number of outstanding shares by the price per share. So it's $10 per share with 1 million shares outstanding. The market value of that firm is $10 million. We're going to get into a number of different type of investments. The first one we're going to talk about are bonds. The second one we were just talking about stocks. Bonds are debt securities issued by either the government or companies. You can receive returns in the form of coupon payments and price appreciation. meaning that you receive a payment every period specified until the bond has matured. So you're holding a bond for 10 years with a coupon rate of 9%. So you're earning 9% off of that bond for the next 10 years until the time it matures. Or with bond appreciation, that means that from the time that you bought the bond, the par value is more valuable than what you bought the bond at. So you bought the bond at $9,500. The par value of that bond's $10,000. The price appreciation of that would be how you would receive income off of that bond. A mutual fund is also an investment. The way that you invest in a mutual fund is a little bit different than investing in a stock or a bond. You're actually using another company to invest in a portfolio of stocks or bonds. So say for instance, a mutual fund sells shares at $10 per share and you buy $100,000 worth of shares. At $100,000, the mutual fund then takes and puts into a company and buys bonds or stocks. And the return that they're getting from the bonds or the stocks that they have invested in, they're then going to give the money back to the people that have invested in the mutual funds. So a stock increases, explodes, or a bond price, the coupon rate that you're getting back for the bond, that money is going to be trickled back to the original investor in the mutual fund. So again, you invested $100,000. You're going to get a return on that investment from the mutual fund as a result of them investing in bonds or stocks. Real estate is another form of investing. You can either invest in domestic or commercial real estate, or like a home or a rental property, or commercial real estate, meaning buildings that lease out to other businesses. The return that you get from real estate is either in the form of rental payments or price appreciation. So you buy a house or a building for $200,000, you sell it for $400,000 20 years later. The price appreciation would be your return on your investment. Or if you bought out a rental property and you rent it out for $1,500 a month, $2,500 a month, that income that you're receiving from the rental would also be considered a return on investment. This is the end of part 1 of Introduction to Investment and part 2 of Introduction to Investing. We're going to go on to a little more details on equations and things of that nature. This was just introductory to a few concepts. I hope you guys hold on to some of this information and bring it over to the next one so that we can apply the information that you're learning here.